Hello, everybody. My name is Joe Fahmy. I'm here with my friend Stephen Place. I'm excited for this trader talk. Stephen is an expert in options, founder of investingwithoptions.com. Stephen, how are you today?
Good. How are you doing?
I'm doing great. You're
You're
also
looking good, man.
you're also an Ali G stunt double. You got a lot of hats you're wearing, so that's great.
Yeah.
All right, I'm excited about this because there's a lot of talk about options lately. You're one of the sharpest people I know with options. Before I got to know you, we have a mutual friend, and I asked him. I said, "What's up with the Stephen Place guy?" And he said he is literally one of the smartest people I know. And I said, "Well, you must only know one or two people." I'm kidding.
That's fair.
No, but that's why I'm glad I got to know you, and you are super sharp with all this stuff. So I want to get into some of the great market calls you've made and so forth. Let's start first of all. Introduce yourself. Tell people a little bit about your site, what you do, and background, and all that stuff.
Sure. About a decade ago, I left a job at an engineering firm and I quit and I started trading options. And a lot of people like my ideas, so I just put it out on Twitter. And then StockTwits approached me and said, "Hey, do you want to run a newsletter?" So I did that, and so I'm a 10-year overnight success on that side of things.
Okay.
I've got a couple different things that I do to help my clients out. The first is Income Lab, and that is a trade service where every single trade entry, adjustment, and exit comes with a video fully explaining why we're looking at it.
Okay.
And then the second one is Proactive Spreads, which is just for credit spreads. And that's just a singular focus with that one. So those are the two things I got going on.
Are these with everything, stocks, ETFs? I mean, the options in your services, or
so
every product, or mostly one focused on, individual stocks or individual ETFs?
With Income Lab, it's options and only options, but the kinds of strategies we use depend on the kind of market environment.
No, what I mean, are they options on stocks? Sorry, I wasn't clear. Or
Okay.
Options on ETFs?
ETFs and individual stocks. We focus on the most liquid names normally.
Okay.
Yeah.
Awesome. I appreciate the intro. Let's start with one of the things I was very impressed with was you made a great call. It was literally, I think, the day of the low, or pretty much close, March 23rd. You put out a blog post about pretty much calling for the market lows in the upcoming rally.
Right.
Explain in a couple minutes what you saw. And by the way, I'm doing this to not only help other people. I'm dangerous enough with options where I understand a lot of stuff. I also don't understand certain things. So I'm going to ask you questions, if that's cool, for definitions, to explain things, because as they say, there's no such thing as a stupid question, just stupid people. So I'm going to be asking you a lot of stupid questions. So try to explain it simply for people. And then if I have questions, I'll just, ask for further explanation.
All right. So to put it in context, I wrote a post on March 23rd saying, here's how the market's going to bottom. Now, in terms of putting calls out there publicly, I nailed the exact top in Feb 2018, the exact bottom in March 2020, the exact top in Tesla, but a blog post does not translate into profits from financial speculation. And I only wish I had the same kind of conviction that I normally do. I've also been disastrously wrong on calls. Like back in April, I was like, wait a second, Zoom feels a little overvalued, don't you think? And here we are, like 150 points higher.
Yeah, no, I appreciate your humility, because look, I'm the same way. I try to put some calls out there, put some content. I'm not saying you're right on everything. I'm not saying I am either. We make a lot of mistakes.
Sure.
I'm just impressed that you've made some pretty damn timely calls.
Sure.
But I appreciate your humility that, you're basically admitting
I have humility because I have been humiliated by the market plenty of times.
We all have.
So it's hard to say exactly what it was. And that's why I wrote the post, just so I could have an archive and say, what the hell was I thinking? Because back then we were going limit up, limit down. Everything was moving. Yeah. And it was very difficult to have any kind of idea of what the market was going through. So one of the main things that sort of triggered it with me, and the whole thesis on it, I didn't say I would get the exact low. I just thought that we wouldn't retest the lows and that the recovery would be Y-shaped instead of V-shaped. That
That's
we would
right.
hit
That's
just
right. I
such an
remember from that was a,
asymptotic.
I didn't mean to cut you off. I just want to say that
Sure.
was a really specific part of the call was we were not, when the entire world was calling for a double bottom, you were saying not only were we going to bottom, but it was not going to be retested. So go
Yeah.
ahead.
So the idea here was that we were in the middle of a pandemic, and the one thing that is predictable about the US government is that they completely underreact to a crisis or can't plan for it. But once the crisis happens, they completely overreact, overplan, and throw an elephant gun at it. Okay. So
Yeah.
one good example is 9/11, right? Didn't, all that shit went down. And then we added more security to airlines. We locked the cockpit doors. You got to take your shoes off and all these things that may not be the most necessary things in the world, but we still do them.
Just throw everything and see what sticks. Yeah.
Right. And that's what we did for like 6 months. We said, oh, we're going to flatten the curve and lock down for 14 days. Yeah. See how that went. And then certain parts of the country are still locked down and all of that's going on. But then the Federal Reserve said, we're going to backstop all corporate debt basically. And they started buying not individual bonds, but they bought LQD, which is an ETF. So they worked with BlackRock and said, hey, we're going to backstop this whole thing. We're going to make sure credit facilities are still open so that it didn't go from a market panic to a credit crisis like it did in 2008. We had three phases in 2008 where it was like, okay, normal bad things and then credit, and then all of a sudden money markets weren't working. So the Fed, I don't think the Fed cares. At the time, they did not care about stock prices. They cared about other structural things in the market. And once they flipped that switch, I'm like, okay, that's probably close to it.
Okay.
The other part of it was that everything got blown out, right? Short vol got blown out. Anybody who was short variance swaps got blown out. Treasuries got blown out both to the upside and downside. And so if you had all these people who had these fairly sophisticated strategies of, say, shorting volatility or buying the dip, once they no longer exist, they can't sell anymore. They have nothing left to sell, which causes the market to auction higher. And that's pretty much what's happened. Everyone's
blown out and the sellers are done.
Yeah.
No, and I think really quick, I'm not a super crazy market historian, but I know they asked Powell in the recent press conference, how do you compare this to 1929? And he says, I don't, because the Fed didn't act until 1933. And in the year 2008 example, they really didn't act until 4, 5, 6 months later, where they really, Powell was basically saying, we came to the market's rescue immediately. Now, there's a whole other really quick, there's a whole other discussion whether that's right or wrong. I don't care. I don't want to get into the morals of the Fed. I'm just saying you're right in that backing corporate credit, narrowing spreads, making sure lending, the structure was going to be secure was their goal.
Yeah. And then you had the elephant gun that got shot with the fiscal deal that was done by the U.S. legislature, where it's like, oh, we don't care about debt ceiling anymore because we're in such a deflationary vortex that we can spend a ton of money, and yields were sub 2% for a while. And so I think that helped to add fuel to the fire where we didn't have to necessarily worry about the demand side of things as much.
Now, was that part of your thinking on a macro? Do you use that in your macro thinking of, saying we're near a bottom, or is it more options or stuff you're seeing in the options market, or is it a little bit of both?
So I try not to trade macro.
Okay.
I just try and trade what's in front of me because I've, look at all the money I've never made trading off of Fed policy. Like it doesn't exist for me. But it was the idea that the Fed government, not just the Federal Reserve, but the U.S. legislature will completely overreact to this and overshoot what is required to stabilize. And then it kind of becomes very stimulative. All right. So that's kind of, this 2020 hindsight, right? We obviously know this now. But that was kind of the idea, to say they're probably going to throw a bunch of money at this and see what sticks, see what's going to work. And that's what happened. And I think I'm comfortable saying that was pretty useful for the economy.
Yeah.
And okay.
Okay, so that was that mainly, if you could sum up, let's say in one or two bullet points, what you saw to make that call. Was that like the actions of the Fed, or did you see something in the options market?
It wasn't the options market.
Okay.
There was a second thing that happened where TVIX, rest in peace, got so big that it affected the overall markets. And once that crashed, I think that was the nail in the coffin for the bear case.
Okay.
Because
Didn't
it
that
just
go from
got
like
got too
20
big.
to 1,000 or something like that?
Yeah, it got up to about $1,000 a share, and a lot of people got blown out on short vol, especially a lot of funds trying to short TVIX or short VXX just a little too early, and that added fuel to the fire. And so that was one of the, I guess, structural things that happened.
And when that trade was done, like you said, no more, everyone blown out, then that also contributed to your. So it's a lot of just sort of experience, intellectual thinking, intangible stuff.
Yeah,
That you
and
can't
within
really.
the context of this, the trades that I was taking then were not going to be super aggressively long trades, because I don't know when the turn's going to happen. So a lot of the setups I was using at the time were long, basically long gamma setups, where I'm looking for either a continued crash or I was looking for a massive rip higher. What we saw during that time was that the option pricing was drastically underpricing the movement that we were seeing. It was, I don't remember the exact numbers, but let's just say the S&P was pricing in a 3% move in the week, but we just saw a 7% limit down. Weird things like that that were going on that made it a little bit easier to structure, so I didn't have to nail the exact bottom, or I didn't have to go out and sell a bunch of puts and then get run over because I'm early. So that's kind of how I was trading it. I wasn't, long-term stuff. I was loading the boat and like just some indexes and some longer-term names that I was interested in. But other than that, in terms of options, I was being a net buyer of options and just making sure that I could play both sides.
Okay. So let's fast forward to some more recent things, not only calls, but let's just, what's been in the news a lot is you've discussed convexity moves and sort of like they're sort of like short squeeze, like what happened in Tesla, for example.
Yeah.
Or there's a lot of talk about SoftBank with one of their new funds, big buyer of options that's helping, especially in like the Nasdaq top 10 FANG stocks and so forth,
Sure.
helping to drive the market higher. Can you explain, like we're all in fifth grade, explain in a basic level what's going on there?
All right. So
if you want to share your screen, by the way, go ahead.
I'm not there yet.
Okay. Okay. Whenever you want to, just go ahead.
So most people know what a short squeeze is, right? You have someone short a stock, the stock goes up, and then they have to buy back that stock. And sometimes the short squeeze can generate enough upside movement on its own. That happens in penny stock land a lot.
Okay.
So let's say you buy a call and the market maker on the other side is now short that call. And that means there's short directional exposure in the stock. But they're also short gamma. And gamma is an options Greek that basically means sensitivity to price action.
Okay.
So let's say they go out and buy a call on Amazon. Let's say it's a 30 delta call. That just means equivalent exposure to 30 shares of Amazon. Ton of leverage, right? A ton of leverage you can get in some of these high beta tech names using call options, which means the leverage one runs both ways. So you have a market maker who's short 30 delta. They get flat by either buying shares or they own calls or they try and balance out their book. And I'm not going to get the mechanics exactly right. There's going to be some nerd out there who knows the exact market microstructure and everything. It's close enough.
They can go away. They can go away.
Amazon rallies, they go, the option goes from 30 delta to 50 delta. So all of a sudden the market maker has to cover an additional 20 shares short, which means that they have to go out and buy stock or a stock equivalent.
So I buy an Amazon call. The market maker is obviously on the other side.
Yeah.
It starts to go up. Does the market maker then start to hedge, or do they hedge from the beginning?
In a perfect scenario, the market maker's balanced on both sides, where they have long calls, they got short calls, they got long puts, they got short puts.
Okay.
Then they figure out their net. They try and, they worry about some other things like Vanna.
So
which
it's
is
like a bookie. I feel like Eddie Murphy in Trading Places. You
yeah,
all sound like a couple of bookies. Like
yeah, that's basically what it
basically.
was. But you had a lot of people buying calls, and so you had market makers get stuck on the wrong side of the trade, and then they're forced to buy and buy and buy and buy until we get to a point where the option premiums are so high it can cushion any further rise, and that's when we see a crack. So we saw that it play out exactly in Tesla in what was it, Feb 2020, when they had that first push to 1,000.
Yeah, yeah.
So that happened there. And it does happen in the options market every once in a while. You get these big squeezes. But what was different about this round was because you had 5 stocks. You got Microsoft, Apple, Amazon, Facebook, and Google.
Yeah.
5 stocks represent 50% of the Nasdaq 100.
Okay.
Because it's market cap weighted index. So all of a sudden, the tail's wagging the dog to a significant amount. And these market makers, they don't necessarily have to go buy Amazon stock. They could go buy Nasdaq futures. And when you have these 5 stocks representing so much of the Nasdaq 100, then it bled into the options market in the S&P and the Dow and the Nasdaq. And so we started to see a convexity squeeze that affected the entire markets. And we saw statistically significant price action in the Nasdaq to the upside.
Correct. So go back. I feel bad because I cut off your example. Right. You were talking about Amazon 30 delta. It starts to go up, and you said about a 50. It turns into a 50 delta.
So the delta is just for every dollar the stock moves, that's how much your the value of your option will move. So if you own a 30 delta call in Amazon, and Amazon goes up $10, you make $300. But there's this extra kicker called gamma, where it's effectively, it's like if you pyramided into a winner, right? So if you bought a stock at 100 and then it goes up, and then you buy more at 110, like the turtle trader kind of method.
Okay.
So that synthetically happens in the options market, where if you buy an out of the money call and it goes to at the money, all of a sudden the at the money call has a 50 delta. So your directional exposure increases the more right you are.
And the market maker has to now buy shares to make up for that change.
Yeah, they can buy shares, or they can buy calls on their own, because they're sitting on the
Nasdaq futures.
Yeah, they could use Nasdaq futures, especially because it got to such a size.
Okay.
Now, to your point about SoftBank, I don't think SoftBank actually mattered as much as what people think, because SoftBank, they were most likely doing stock replacement strategies where they already owned Apple or they already owned Amazon. And so they would sell their stock and then buy the calls, because that's, instead of, if you want to hedge, you buy a stock, you buy a put, right? But a long call and a stock with a put combination are synthetically the same thing.
Okay.
By buying a call, it takes off 80% of the capital required in the trade. So that's probably what happened.
So you can buy in the money calls to replace the stock.
Yeah, or they can buy out of the money calls to replace the stock. It just depends on what they wanted. So we don't really know how the SoftBank thing is going to wash out. I just know that they were buying longer dated options, and a lot of the speculation that we were seeing was in short dated options, and that's where the convexity squeeze really can come into play. If you have a bunch of people buying out of the money weekly options, most of the time they'll get smoked just from the time decay of it. But if you get enough people doing that in a bull market, in some of the strongest stocks that are basically a source of liquidity for institutional funds and like the only game in town, that's how you get that fire to the upside.
So this is either a really brilliant question or a really dumb question. I'll let you decide.
All right.
If people know that this can happen through buying, let's say, everyone plowing into weekly options, forcing the option makers market makers to buy stock, why wouldn't everybody just do this to manipulate stock?
That's what Wall Street's bets is for.
That's what
Wall Street bets is for, where you have this forum on social media that's saying, hey, let's go buy a bunch of calls. I think that there is a flavor to that. Don't read too much into that.
No, I'm not saying conspiracy there. I'm just saying, if you know, just from structural point of view, that buying all these calls can lead to a stock running, if a fund or whatever, so whatever,
Sure.
objective someone has wants to do that. What's to stop someone from doing that?
It is it is what you just explained. Everybody buying a bunch of call options to trigger convexity squeeze is a necessary part of it, but it is not sufficient. Like, you have to really have the stars align on a lot of things.
Okay.
Most of the time, you're not going to see that. You can't go, for example, you can't go to all your buddies and say, let's go buy a bunch of out of the money calls on ExxonMobil and it's going to skyrocket higher, because ExxonMobil looks like trash right now.
Can you pick a better company? No,
right. So you have to have a lot of things working. You have to make sure that the stock's in a stable trend. You have to have momentum on your side. You have to have some stories on your side. One question for the viewers watching this: how can you anticipate these convexity squeezes before they happen? I think that is a good thing to start looking for. I asked the dumb
questions, you asked the smart questions. So go ahead.
And I think that's a good way to develop trade systems, especially with options, to say, hey, how can I find these names before they really start to run, or at least have the best odds of seeing some kind of a volatility event. From what I've found, you've got, I look at the ADX a lot to say, okay, this stock is about to go from a mature trend, or what is
the ADX?
Let's pull it up.
Go ahead. Yeah, please.
So the ADX is something that I'm not going to remember the actual name of, because I'm talking at the same time.
That's okay.
But it shows you the trendiness of, it's advanced decline. Is that it?
Is it the advanced decline line ratio or something like that?
Yeah, it's something like that. I'm on TradingView. On Thinkorswim, it's different.
Okay.
But let's just try and steal someone. Nope, that ain't going to do it. All right, whatever.
It has to do with advanced decline.
No, that's why it throws you off. It's like the RSI is a relative strength index, but it has nothing to do with relative strength.
Okay. Yeah. Why would we do something that makes sense? I get it.
But the ADX, because I can't find it right here because we're doing live video, basically shows you the trendiness of a stock or a market.
Okay.
And it doesn't care which way the trend is going. So when we were crashing in March, the ADX was really, really high. See if I can hunt it down really quick.
It's okay.
All these custom, let's try this. I don't know, whatever. It's out there.
All right. Okay.
But what you can find is that if you look for stocks that have had very, very low ADX readings and are about to cross, so I'll use the ADX and I'll have a moving average to smooth it out a little bit. And once you see that crossover, it's saying, okay, we're probably due for a phase in the market wherein this stock is about to go bananas to the upside. And so if you look at the major runners that we've seen recently, or if you go back and you look at all the major runners, they all have that same condition, where the ADX is rising above its 20-period moving average. So that's a good filter to have, to say, okay, is it possible that this stock is going to see convexity squeeze? Well, is the ADX rising? And
now, you also said there's a lot of factors, so you would also need call buying to come in.
Yeah. So you need to have really liquid options. You would probably need to see the implied volatility on call options start to kink up. And I know that's kind of an advanced or a very weird sounding phrase. In a normal market, what are people scared of? They're scared about downside risk. And so you will have investors, they will sell calls and they'll buy puts. Sell calls and they'll buy puts. And so the implied volatility, the demand for these options on calls will always be lower than puts.
Okay.
And puts will be higher. So that's the option. That's what we call skew. What we've seen in these NASDAQ stocks is that the skew became a smile, where demand for out of the money calls became really high. So that is another signal to say, hey, this sucker's about to go parabolic. And you can either try and ride the trend and hold on for dear life and try and exit before, or you can start to consider short strategies once you start to see signs of exhaustion. It's that easy, right? But that's the overall idea, right? And that's a good starting point for traders to consider, to say, okay, where can I find these ideas? Now, what we're seeing in the market right now is a lot of those call options are getting smoked. Like the premium's going to disappear. So you're probably going to have a time for these stocks to reset for a while before you see another kind of convexity squeeze. I'm actually expecting, since we're sharing our screen, I am expecting convexity to manifest in some of the COVID proxy names. So casinos, cruise lines, airlines, banks. As an example, JP Morgan, which has sucked for a month.
Yeah, every time I punch in JP Morgan, it's at $100 every time. It doesn't matter when I punch it up.
But again, volatility runs a cycle. You see volatility expansion and contraction. JP Morgan and all the banks have seen 6 months of volatility contraction. Okay. They didn't retest their lows in March, but they also haven't squeezed higher. If we see a drop in the 10-year soon, then you'll probably see JP Morgan run to 115. You'll also find, if you go look at the call options, they're really stinking cheap. And they are a better play right now than trying to guess exactly when Apple is going to bottom, because they're going to be cheaper options relative to large cap tech.
Okay. I mean, I kind of noticed that just from a technical perspective, when some of these things came down, they just need a little time to consolidate and digest that drop.
Right.
So what you're saying, we could see that continuous sector rotation into the beaten down sectors, financials and airlines and casinos and stuff, that we could see a rotation into that while tech is consolidating and digesting its recent move.
I think that's a reasonable thesis to have. One of the things that, people say, this is a straw man, obviously, don't trade the news or things like that. What I care about are narratives. And when price action runs contrary to an expected narrative, that's a signal. As an example, what do we know? I got a booger. Hold on.
That's all right. It's live.
Yeah, it's live video. I can pick my nose on live video.
You're allowed. Yeah, no one's watching this. Don't worry about it.
All right. What do we know about commercial real estate? From the narrative, right? It's screwed. It's screwed, and no one's ever going to go to a restaurant again.
Ever again. We're never going out
blah,
again.
Blah, blah, blah. And it's like, okay, this narrative is a very mature narrative. Everyone and their mother believes it. Here's a chart of IYR, which is a commercial real estate ETF. It's near 6-month highs. It did not crack with the rest of the market this week. That's relative strength. And it's like, wait a second, the price action is running counter to the prevailing narrative of the time. That's a signal. And so you've got the potential for a squeeze in those names. That, we're kind of diving into tactical hell and things that will matter within the next 2 weeks, but don't matter,
it could be a short-term sector rotation. The problem with sector rotation, I've tweeted this out so many times, is if you try to chase that, you can't keep up with the computers. So now if you're like, okay, I'm going to sell my Apple and jump into JP Morgan, by the time you do that and it's sticking straight up in the air, now JP Morgan's coming down and Apple's running. And if you try to keep up with it, at least my opinion is you're screwed.
So I want to show you one chart that I've been obsessed about for a month, 2 months now.
Is this a chart of my weight during COVID? Because it's going straight up.
You know what? I started a program called 75 Hard, and it's an app, and it's basically behavioral modification through a streak. And so I have to work out twice a day, keep a diet, and then if I break my streak, then I have to start over from day one. And so there's kind of this incentive. And then this guy kind of yelling at me saying, hey, if you break your streak, you're a loser. And nice. I'm on day 26 and
good for you.
I am the strongest I've been in a very long time. I'm sleeping better and it's magical because it's not, I already know what to do.
No, we all know what to do. You just lost me at working out twice a day. But anyways.
Yeah. Well, working out, you can be mobility or jogging.
I know. I'm kidding.
This is a chart of VUG versus VTV. So this is a chart of the Vanguard Growth Index relative to the chart of the Value Index. And this is the most
This is off the charts, literally, no pun intended.
It's multiple standard deviations to the upside.
Yeah.
And it had been trending a little bit, but it really took off in 2020 because what are the growth stocks? These are tech stocks that can grow.
Right.
And what are the value stocks? Basically everything else. So when COVID hit, what are the stocks going to run? Oh, we're going to order dog food on Chewy, or we're going to get a Peloton, or we're going to do all these other things. You know, we're going to get a Zoom license, because who doesn't have a Zoom now? But this is so stretched. And if the prevailing narrative related to COVID starts to go away, you'll probably see some hard reversion here.
If there's a positive news on a vaccine, antiviral, something like that.
Do you want me to say the thing that can't be said? This will probably get you demonetized on YouTube.
I could care less. Go ahead.
All right. Herd immunity is already hit in certain regions. And herd immunity is not 75%, it's 20%.
So explain that.
All right. This is really going to get me in trouble.
No, I don't care. Fuck it. We're having fun. Go ahead.
All right. Basically, from my crash course in pandemics that I've had this year, herd immunity is where the threshold where the R naught goes below 1, where the whatever you have cannot grow at an exponential rate and will start to decay. And what we found in New York, New Jersey, is that when you hit a certain sewer prevalence, so when you have enough people with the antibodies in their system, all of a sudden the disease can't work anymore. And what we found in New York when they ran randomized sewer prevalence tests, sub 20%.
Okay.
And so what you're finding in all these states is that when we get a case count, about 16% of the population, all of a sudden the curve drops.
I did see Mark Cuban. He tweeted out something about a higher incidence of positive cases in college students, but 0 hospitalizations. And again, it was just went through my stream, but
right.
Is that kind of what, and he was saying this is positive, that maybe the virus is getting weaker, or hurt him. Is that kind of what you're getting at?
There is a possibility. I'm not a scientist. I am very good at data. But what we know from, because you have the CFR, which is case fatality rate, and you have the IFR, which is infection fatality rate.
Okay.
And then if you split it up by demographics, if you are under the age of 65, the infection fatality rate is lower compared to the influenza virus.
Okay.
So that's what we know. That's what we know right now, that if you're older, it's very bad. If you're younger, the flu is worse. Okay. Until the evidence goes to the contrary. And so you have this idea, everyone's looking for a vaccine and all these non-pharmaceutical interventions, these NPIs. And it's like, okay, the NPIs don't work, right? Mask compliance doesn't matter when you look at mask mandates relative to the overall growth curve of COVID cases. It just doesn't matter. Lockdowns don't matter because you have certain areas that lock down and they have the same outcomes as those that don't.
That didn't. Yeah, I get it. I mean, look, I know you're brilliant with the numbers and stuff. I don't mean to cut you off. I just know people are watching and they're like, shut up.
I know. I need to shut up about
Shut up,
this.
clown. Make me a bicycle. Give me some options.
To circle back.
What calls can I buy tomorrow? That's what they want.
I know. To circle back to this, if that narrative starts to manifest itself,
yes,
then you're going to see some moves.
The economy stocks go higher. I want to talk really quick about 2 things. You talked about, give me 2 minutes on your rug pull video, August 31st, which I must say is amazingly freaking timely. What did you see when you said the upcoming rug pull in tech, which was literally a day before that?
So for what we just talked about, all that convexity stuff.
Yeah.
Basically what happens is once the option premia is high enough to cushion any further upside, that's when the market cracks. We saw this in silver in 2011. We saw it in Tesla in Feb 2020. We've seen it in individual stocks all the time, like GoPro and Yelp when they went parabolic a long time ago.
Okay.
But this just happened to be because these stocks were so large that it affected the entire tech space. And that's why I was expecting a rug pull in tech. I didn't know it'd be 2 days later. Now it's not timely because I wanted to do the video like a week previous. I just didn't get to it. But yeah, I made some money on the downside in tech. I think that was a good trade. Where it goes from now is kind of a.
But now, if you can explain. Coming out of that, you've posted a video why the market can't crash. If you can explain, and I love that video, by the way. People can find you on YouTube, and I'll include the link below this, by the way, where they can subscribe and check out your videos. But can you explain that reasoning?
All right. So when everyone is complacent, or when everyone's short volatility and shorting a bunch of puts, very bad things can happen, right? The market is not complacent. When everyone and their mother is hedged to the gills, it becomes stubborn. The price action becomes stubborn. It's very hard for the market to drop. Let's say you buy a put, okay? And we'll just put a chart on VXN right here. All right, so VXN is the VIX for the Nasdaq. It shows the demand for Nasdaq options. It's currently in the 40s. If I told you in any time in the past decade the VXN is in the 40s, you're like, oh God, we must be crashing, right? We've seen what, 3% off the highs. So if everyone and their mother is overhedged, if you go out and buy a put and then the market drops and you say, cool, I'm going to take profits on my hedge, I'm going to sell that put, right? The same mechanics. Market maker takes the other side. That means they're long a put and they're net short delta. They're net short directional exposures, so they have to go out and buy futures or rebalance somehow. So when you get enough people dumping their hedges off at profits, it creates a natural floor in the markets, right?
Okay, I follow
People who are buying their hedges right now, what are they scared of? They're scared of no new fiscal stimulus and then the election, right? When has that really worked to the downside? Last time was fiscal cliff 2011. But then if you think about 2016, you think about Brexit, and you think about 2016 election, we saw strong moves to the downside that were immediately rejected. Why? Because people are rebalancing and closing out their hedges, right? And the same kind of thing, I think, is happening right now.
That's actually a question. I'm glad you brought this up because it's a question I want to ask you from the 2016 election, and it might apply to this upcoming election. I spoke to a hedge fund manager that manages in the billions of assets before the 2016 election. And he said, we're not selling any shares. We are just perfectly hedged. And I said, what do you mean? He says, if we drop 10% after the election, because the narrative at the time was if Trump wins, we're going to crash. If Trump wins, we're going to crash. Everyone and their mother was saying that. So he said, if there is a crash, we are perfectly hedged with options in case we drop 10%. Now, my question to you is, this is what I think happened. How many people were hedged into that known event? And when the futures were ugly overnight, I'm sure a lot of people remember, the Dow futures were down at 800 points or something.
It was limit down.
Limit down. Yeah. And even Carl Icahn was being interviewed and they said, the futures are down, limit down. He's like, hold on, I got to go buy calls. Because he's like, he left the interview to go home and buy calls, or buy futures, whatever he did. But anyways, my question to you is, if the whole world is hedged and then they're thinking, let's say you buy a put for $1, you're thinking the next morning, hot diggity, as this thing's got to open at $20, I'm going to make a fortune. And if everybody's on that side of the trade, do the market makers say, nah, I don't think so, buddy. So now overnight, the futures start climbing by the open. The spreads are blown out of the water so you can't get in or out. And by the time the market was positive, all those puts that everyone bought for $1 expired worthless. Is that basically how it works?
That is not the full mechanic of what happened.
I know, I'm explaining.
But it is a good assumption. That is pretty much what happened. Where if you buy puts, let's just say it's an earnings event, right? Yeah. We know it's a risk, right? So let's just say you buy puts. Well, you can't close those puts in the aftermarket session. So you actually go out and you buy stock to lock in your profits. So if you get enough people buying futures to lock in their hedge profits, all of a sudden we get back to flat, right? And then anyone who did not lock in their hedges are now saying, oh shit, I have to close these out because we're going to get crushed on the implied volatility collapse. And then again, fuel to the fire, right? And that's what can happen.
Okay. So go ahead, because I have another question, but go ahead.
All right, I have when's the election? When was the election? 2016. It was beginning of November.
First Tuesday of November, so whenever that is.
So this is the VIX futures curve from October 2016. So this was about a month out. And they were 15, 16, 17, 18. So a pretty normal curve. Now I want you to compare that to what we have right now, where it is the weirdest looking vol curve we've ever seen, right?
You just compared the last election heading into the last one with the current one.
Yeah, where instead of being at 15, 16, 17, 18, we're at 29 and 36.
Okay.
The VIX futures market is already pricing in really nasty action. So when we think about risks in the market, the risks are rarely from the known unknowns, right? To paraphrase Rumsfeld, right? It's when we see a transition from an unknown unknown to a known unknown, right? Good example, Aug 2015, when China did something with their currencies and all of a sudden we're down 3 to
The
5% in
yuan
a single day.
devaluation. Yeah, I remember.
Yeah. So that all of a sudden became a risk, right? It's rarely from something we know is going to happen in the exact
Something
date.
that's telegraphed, everyone can hedge for.
Sure.
That's when it rarely goes down. It's when the surprise comes, Brexit, yuan devaluation, and then everyone hedges. That puts the floor in.
We're going to look like such absolute dopes in November, because now that we've said this, the market gods are going to descend upon us and show how wrong we really are.
No, but my question is comparing, and I didn't mean to make it a long-winded question about 2016 election. Everyone, because we're stuck at home and people are monkeys and brainwashed by the news, everyone's going to be horrified going into this election. There's already talk, if Biden wins, cut $20 off of S&P earnings, or this might not be decided the night of the election, whatever the fear and bullshit is that's out there. My question is, do you think the same thing, because of the fear of a known event, that everyone's going to hedge and, God willing, the market gods don't mess with us, that this will end up being a non-event?
I don't know. That's a hard question. I think that the biggest risk is if it isn't a runaway from either side, and then we get into a nasty legal battle, then that becomes, if it is an uncertain event that is protracted over weeks instead of being a one-off like earnings event, I think that's where it can become a little bit more of a problem. But again, a VIX in the 30s when realized vol is at 15 is a bit much. And so it becomes incredibly difficult to hedge right now. It's really, really expensive to hedge.
Well, because they know everyone's hedging, so they jack up the prices, right?
Well, it's not there's no conspiracy. The market's a market. You just have more demand than supply.
I mean, the more demand increases that vol, or that implied volatility.
Yes. And so some of the vol involved was upside call buying. Everyone was buying calls, and that can affect the VIX, but you still have a lot of downside risk being priced in, and it's a lot. So it is like, I use car insurance as a good analogy sometimes. A mother of two with a minivan is going to have a lower insurance premium than a guy in a red Ferrari who's like divorced 3 times.
Okay.
And right now, the market is currently pricing in red Ferrari when the current price action we've been seeing is mom in a minivan.
Okay.
And so
I like that analogy.
Unless we see the actual volatility in the market pick up, like actual price action, then it really doesn't justify buying premium at 30%. There are other ways to hedge. I think we have a Twitter question. We'll get to that in a second.
Yeah.
But one thing we can do really quick is you can take the VIX and divide it by the square root of 12, and that's your expected percentage movement over a month about. So what are we at, 30? I can never do math while I'm talking.
That's okay.
30 divided
I can't do
by,
math when I'm not talking, so don't worry about it.
Where did the square root button go? Do you know the square root of 12?
Square root of 12 is 3 point something. I don't know.
All right, hold on. 30 divided by...
Square root of 9 is 3, isn't it?
All right, it's 8.6%.
Okay, I was
so
way
the
off.
market currently is pricing 8.5% of movement in the S&P within a single month. That's a lot. That's a lot of price action.
What's that formula, by the way? You're taking the VIX and you're what are you doing?
Dividing it by the square root of 12.
Okay.
That's a quick and dirty way. If you want to look at expected daily movement, you divide it by the square root of 252.
Okay, so you're doing the monthly, what they're expecting for the month. That's why you're choosing square root of 12.
So if you want to buy hedges right now,
that's actually really cool. Thank you for sharing that, but I didn't know that.
Yeah, you need to see about 9 percentage points of movement to justify buying just straight up puts right now. So it's a tough trade right now to justify buying hedges into this.
I have a feeling we're going to do a few more of these because there's like a million questions I have, and I don't want this to drag on too long. I do want to get to, I'll pick one question because it's from someone I know, best way to structure leaps trades on large caps. Or is that
I don't
something
know.
you'd rather get into another time?
So, if you want to be consistent across different asset classes, the delta determines your entries. So what is the perfect one? There is no perfect one. It doesn't exist. But if you wanted to get something that looked a little bit more like stock replacement without paying up, around 70 delta is where you want to start.
Okay.
And then the delta will adjust depending on the volatility and the expected vol and things like that. But 70 delta leaps. And then what you can do is you can basically have a synthetic covered call where you go 2 months out, you sell a 30 delta call, and you've got something that can return 10 to 15% within that time frame. So that's one way to do it.
Okay. Another question, or several, and we can get to these in another video because I don't want, like I said, I don't want this to drag on too long, but a lot of the flavor of the questions were hedging strategies for portfolios. And I know that's like saying, okay, just explain to me what you do in 2 seconds is insulting, but is there something quickly, if someone, let's say, just use a round number, has $100,000 in equity, and they don't want to sell their shares, but they want to hedge that?
Okay. It's hard right now for everything we just talked about. The VIX
For the
and
reasons
VIX
you talked
futures
about,
and
yeah.
S&P options are so stinking expensive. So if you want to hedge, you cannot look at just buying puts straight up. I like October put butterflies. I like Octave put calendars. There's some very fancy voodoo you could probably do with the VIX futures curve where you could do calendars on that. And then on individual stocks, what you could look at, I know you said don't sell stock, but you can sell stock and then you can do risk reversals instead, where you buy an out of the money call, you sell an out of the money put. It synthetically has the same directional exposure. But
you write the put to fund the call.
Yeah. And you use that instead of owning stock straight up.
You're a willing buyer if it drops.
Yeah. And honestly, like, because vol is so rich right now, one other hedge to consider is selling put ratios, where you buy a put and then you sell 2 times as many, or you sell 3 times as many puts that are further out, where you can structure it where if the market rips, you don't make any money. Maybe you make a little bit of money. If the market pulls back, let's just say anywhere between here and, I don't know, minus 15%, then you can get some profits. If it's between 15 and minus 8%, then you make a lot of money. And then if the market crashes, then that's where you have to get into active risk management. A lot of people got blown out of that trade during the crash in March 2020. Because they all got blown out, that means it'll probably work now.
Possibly. I'd have to think about that one.
It's hard.
I think recency bias affects people too much, where if something just happened, they protect. Like,
well, no, it's because of the structure. There's no one left selling volatility anymore. They got blown out in the volpocalypse in 2018, and they got blown out in March 2020. So the vol selling side and the option premium selling side is not a crowded trade anymore. It's not recency bias. It's just that the whole playing field got cleared out, and so it's a lot easier to do.
They put their hand on the stove too many times, and they said, screw it, I'm not going in the kitchen anymore. Yeah, I get it. Hey, I have a feeling this is part 1 of I don't know how many parts, because I love this conversation. I hope people who listen in got some good stuff out of it. I learned a lot, and I just love just regular market talk. Let's end with this, because you talked about this in the beginning, and I always love talking about psychology. How do you deal with, you make some great calls like you referred to in the beginning, and you might not have executed it as well. Like, how do you deal with that psychology part when you're like, shit, you know what? I made this call and I knew this was going to happen. I just didn't either pull the trigger on the trade or execute as well. How do you deal with that?
So there exists an opportunity cost with not going with enough size on the trades you have the highest conviction with. You know, if you're just starting out, position size probably should be constant, but the what I'm trying to do with this is, we know that, for example, these convexity trades are going on. And like in Feb 2020, I was like, man, I know Tesla's going to rip, but I just don't have the right kind of risk tolerance, or I don't have the right risk structure, even though I know it's going to happen. So I used that lesson of the missed opportunity cost to walk forward the things that I wanted to do the next time I saw it. And we saw it in Tesla again, like what, 4 months
By
later.
the way, to close out, I didn't mean, do you want to unshare your screen just to close out, if you don't mind, just so we can see you?
Sure.
Just so we can see it, because I want to, like, there we go. Perfect. So go ahead.
Yeah.
Sorry.
From all our experience in video production.
We're just experts.
So yeah, when you review your trades, and you should review your trades, right? You should do this a lot. It's not just about the winners. It's not just about the losers. It's also the missed opportunities from trades that you, God, what is it? It's like null hypothesis, or there's a statistical term for it, but basically the trades you missed out on can be lessons in and of themselves. And if you can identify those on their own, then you will have a much better expectancy going forward. That's one of the reasons I use the ADX to identify convexity squeezes, because I went back and I said, let's look at all these names that ripped higher. What do they all have in common? Well, an ADX rising. So that is a lesson that I use that I can now walk forward in time.
Okay. All right. Because the reason I ask, because I know with stocks, it sucks if I say, hey, I love this at 40. I don't take the trade. It goes to 60. That's one thing. I know in the options world, though, it's I could have taken this for 2 and it went to 20 or 30. So the percentage gains can sometimes, I would think it messes with your head a little bit more. I don't know.
Right. And there with the percentages, especially with options, if someone rolls up to me and is like, hey, I made 2,000% on that. And I'm like, all right, you traded 5 contracts. That's nice. You know, no one's trading any size, you know, looking for the 2,000% wins. It's nice when it happens, but that you have to have some kind of outcome independence with from that. You have to kind of step away and say, let's just make sure that the systems and the processes are in place. That way, because you don't know which one's going to be the one, you just have to make sure that you're in the right spot so you can hold on for dear life and try and ride that trend, and try and pull out as much as you can, because you really don't, it's impossible to know which one is going to be the next big mover. You just have to make sure that you're in the right place at the right time, at least when it comes to options.
I think that makes a lot of sense. It's a lot about the consistency, and I just love talking about the mental toughness. And I would just think with options, there's a lot of second guessing, especially because of the types of percentage moves that can come. But
sure,
I think you're basically saying it's just about being consistent and moving past that and having more of a consistent strategy and structure to your trading.
Look, easier said than done, right?
Of course.
It's just going to be a constant struggle no matter what level in the game you are at. But that's a good thing to consider.
Awesome, my friend. We'll leave it at that. I have a feeling we're going to come back and do a few more. There was a lot of awesome questions, so I apologize we didn't get to them. Maybe we'll just do another one at some point. Tell everyone again where they can find you.
Twitter at Stephen Place, StockTwits at Stephen Place, youtube.com/investingwithoptions, investingwithoptions.com, and then to get a trial to my services, investingwithoptions.com/join. I think is the right URL.
Awesome. I will include all of those below this video. I thank you for your time, my friend. We'll definitely do this again soon, and good luck with all of your trading, of course.
Right on. See you later.
All right. Thank you, man.